Welcome to digital learning platform of Shri Guru Sudindra College, course Bcom 6th semester, subject cost accounting, topic reconciliation statement. Reconciliation statement is a statement prepared to equalize the profit or loss ascertained under cost account and financial account. Some business concerns maintain cost and financial account separately. Profit or loss ascertained by these two sets must be equal, but in actual practice they are not equal because some financial items such as purely financial expenses, goodwill written off, preliminary expenses, etc., or purely financial incomes, rent receivable, interest received, etc., are not recorded in cost account, and some items shown only in cost account but not in financial account. As such, profit or loss disclosed by these two sets of account are different and are to be equalized. To equalize the profit or loss, reconciliation statement to be prepared. Let us see the format. Here the format starts with profit as per cost account or loss as per financial account. Some items has to be added and some items to be deducted to equalize the profit or loss of financial account as well as cost account. First we'll see what are the items to be added. In that first one, over absorption of overhead or over recovery of overhead in cost account. If the overhead or expenses mentioned in the cost account are more than the actual overhead is called over recovery of overhead. As expenses increases, profit decreases. To overcome this mistake, we add over absorption of overhead in cost account. Second one, financial income credited in financial book only. Some financial income such as rent receivable, interest received, commission received, etc. are recorded only in financial account. As such financial incomes are not recorded under cost account, profit decreases. So we must add financial income credited in financial book only. Third one, certain items or expenses charged only in cost account. Some expenses shown only in cost account and not in financial account. At that time, due to more expenses, profit decreases. To overcome this, we add certain items charged only in cost account. Fourth one, overvaluation of opening stock in cost account. When opening stock increases due to more stock of material, the cost increases. As cost increases, profit decreases. For example, if we take opening stock rupees 50,000, due to more stock, cost increases, that is rupees 2,60,000, and profit decreases. To overcome these, we add overvaluation of opening stock. Fifth one, undervaluation of closing stock in cost account. And even when closing stock decreases, profit also decreases because consumption of material is more, by that cost increases and profit decreases. For example, if we take closing stock rupees 10,000, due to less closing stock, cost increases and profit decreases. So we add undervaluation of closing stock in cost account. Then we get profit as per cost account as well as financial account. Now we'll see what are the items to be deducted. In that first one, under absorption of overhead in cost account or under recovery of overhead in cost account. When the amount of overhead charged is less than the actual amount of overhead incurred, it is known as under recovery of overhead. As expenses decreases, profit increases. To overcome this mistake, we deduct under absorption of overhead in cost account. Second one, undervaluation of opening stock in cost account. When opening stock decreases due to less stock of material, the cost decreases and profit increases. For example, if we take opening stock rupees 10,000, due to less stock, cost decreases, that is rupees 1,80,000, and profit increases. To overcome these, we deduct undervaluation of opening stock in cost account. Third one, overvaluation of closing stock in cost account. And even when closing stock increases, profit also increases because consumption of material is less. By that, cost decreases and profit increases. For example, if we take closing stock rupees 50,000, due to more closing stock, cost decreases and profit increases. So we deduct overvaluation of closing stock in cost account. Fourth one, purely financial charges. Here the financial expenses are recorded only in financial account and not in cost account. As expenses are not recorded in cost account, profit increases. To overcome these, we deduct purely financial charges. Then we get profit as per financial account or loss as per cost account. Thank you.